multiple teams doing multiple things. Um, I would say that um, most of my time is actually spent between two things. One, supporting our engineering on week to week progress on blocking, whether it's product design, front end or back end engineering, and also like just make sure that we keep the ball rolling on the week to week basis. One of the challenges of running a decentralized organization, especially one that's remote and spread out across multiple time zones, is to make sure that folks are always continue to be grinding and folks are motivated, that we're working as a team and we're moving in the same position and folks are in sync, and that's not always as easy as it sounds. There isn't an office or something where you can just show up every day and see what people are doing. Sometimes a lot of it is just knowing, like, when to reach out to people when they're getting stuck and help nudge things along. And yeah, like that, I think most of my time is spent on that.
What have you seen about this mental health type of aspects in the development team? I know that they don't trade as actively as BD or marketing guys will do, but does it impact them, the bear market?
I wouldn't say that. I think probably some folks on our engineering team will surprise you. I'm pretty sure that the engineering team owns more bored apes than anybody else on the non-tech team, for example. And actually, most of it is just knowing that um, engineering requires like sustained periods of focus to write good code. You can't just like it's not like 30-minute calls or like 1 hour meetings. You got to be able to bang out stuff like over multiple weeks. And so this is nothing to do with like crypto or DeFi or anything, but like just managing engineering teams, you need to know like the rhythm, like when do we sprint, when do we chill, right? And most of the summer, to be honest, like we delivered like a very heavy roadmap first half of the year. August, I think we gave people a lot of time to kind of just rest up, do clear up some backlog, and just get everyone some rest, and get ready to bang out killer features in September.
Maybe you could just talk around like high level a bit more about the direction of auto pools on the decks, and the role that these auto pools are playing for our liquidity, and yeah, why we have auto pools in the first place.
Yeah, why do we have auto pools in the first place? Um, so I think when after we launched an Arbitrum, I think maybe around, I want to say around February was when we were first starting to debate whether we needed to build our own liquidity management product. And our thinking at the time was that there were some existing Uniswap V3 liquidity managers, but none of them were really shaking up the industry. And they adopted a particular approach that I think made assumptions around how Uniswap V3 worked. And we just felt like Liquidity Book has a lot more flexibility in its architecture. You are able to build much more custom strategies around how liquidity can be distributed. And so we figured, well, if there's any team that knows best about how to make the most use of Liquidity Book, it might as well be us. And so that's why we set about. So there were two motivations, right? One was we knew that the customer problem, users, sometimes had difficulty keeping up with the market, right? Like, I think a lot of folks have experienced this. Like, the you put in some ETH in USD or AVAX in USD, and then 3 hours later, it got completely transferred to USD or something. Market just rallied or something, and then you need to be able to rebalance. And so, auto pools were formed to address that particular pain point, like an automated solution just to keep up and rebalance regularly. And the second was that, to make the full use of the capabilities of the liquidity bin architecture. So, those were the two initial motivations for doing auto pools in the first place. But what we found was that after we've launched it, right? Like folks that had an idea of like how they wanted to deploy their strategy and manage it manually still did that, right? And we always assumed that the automated solution would be superior, but actually even in classic yield farming, that's not true, right? Like there are lots of people who like to auto compound, like maximize the yield with like per second basis auto compounding, and just juice up yield farming returns. But there are also some that like to just collect manually. They like being in direct control. They don't like to turn it over to aggregators and yield farming protocols. And I think that's what we observed as well. Like there definitely were some users that tried out auto pools after trying being a manual LP. But there are also lots that just felt like that's not what they wanted to do. Like they felt comfortable providing liquidity manually. And then there were also users that couldn't figure out what they were supposed to do in the first place, stayed out, and then joined. They were like new users to it because they felt like, hey, auto pool sounds like something that's much more easy, it's much more passive. Let's give this a go. And so we started by saying that auto pool is an automated solution for people that were already manually LPing. But what we then saw was that the actual users using auto pool are very different from the manual market makers. And so then we started getting questions from users around they had a different set of expectations. I think people didn't necessarily see it as an automated version of the manual LP. I think they were expecting something much more. And it really took a long time for us to properly unbundle like what's the right way to frame it. Like even for us ourselves, we sometimes have trouble like explaining why like the auto pool might be presented in a different way that people expect. So after all of that, like what's happening now? I don't think that people should expect auto pools to perform like ETFs, right? This is not like a mutual fund or a hedge fund where you put in money and you just wait and sit back. We have spent a lot of time and effort trying to analyze auto pools and liquidity book market makers to understand like, hey, who's profitable, who's not, and under what conditions can they be profitable. And it turns out that yes, there are auto pool users that are profitable and some that are not. And it actually, a lot of it depends on the timing of the market, like when they entered the auto pools and what did they enter the auto pools with. In other words, this is, the experience of the auto pool also depends a lot on the view of the user and the market outcome. It's not the same outcome for everybody. And sometimes it's not very easy for people to understand, because compared to what you might have been used to in yield farming, right? Like it's a fixed APR, fixed amount of tokens you pump out, and it's very predictable. This one requires you to have a view of the market. So I think what's going forward next is like, we, rather than trying to come up with some golden strategy of making the auto pools like forever up only, like have some unicorn strategy that's always going to print money. Like I think that's definitely a lofty goal. I don't know that's realistic. We're going to try add more analytics and transparency so that people can understand like what's the right way to think about the performance of the auto pools. So, for example, I think in the coming 1 or 2 weeks, we should be able to surface new analytics for the auto pool users to compare against benchmarks. So 7-day benchmark, for example, versus Ethereum or versus USDC. So, so you can compare like, hey, versus a week ago, if you were all USDC or all ETH, how did that, compare versus what the auto pool did? And I think an interesting one would be to also add a benchmark of, a 50-50 hodl. Surprisingly, when we analyze the auto pools, a fair number of users, deposited exactly 50-50. Like, I don't know whether this is what they just happen to have in the wallet or that's how they're used to doing yield farming, but a good number of them deposited in exactly 50-50. So I think that's also like a benchmark that we're going to try and display to the users.
Why going the path of building something on our own instead of using something like in the chatter saying, oh, gamma strategies or whatever? Why does Trader Joe build instead of implement?
So there's two reasons. One, none of them wanted to build it. And two, I think it's also difficult for them to fully grasp and maximize the liquidity book architecture. I don't think there are other teams that understand it as well as we do. So we might as well be the one to build it.
Like, where do you see auto pools, I don't know, 3 months from now?
I think that's really hard to predict. I do know that there are demand for auto pools, for example, the stable ones, and probably some things that are like, I wouldn't say pegged assets, but similar to like liquid staking derivatives. There's some appetite for that, and it's not just for us. We can see that on other platform protocols like Maverick, for example. There are demand, whether it's from the protocol partners themselves or from the liquidity providers, to be able to supply this kind of liquidity, and to be able to provide some automated version of this so that we can improve the efficiency of those markets. So I can see that there's the demand, but beyond that, like, it's hard to say. I think crypto markets move so quickly, like, it's, who knows, right? What if Jay Powell decides to lower rates? I mean, it's doubtful, but who knows? Like, if something happens next, then there's some completely new paradigm, and then we'll have new things to trade. I think for us, we're actually focusing more on the internals right now. So making, we have a backlog of auto pools that we want to build that roll out, and we're going to do that. We're still testing out the farms and the rewards to see, like, how people respond to those. But beyond that, I think we're just keeping our eyes open.
Okay, let's talk about real world assets then. Or more broadly, I don't know, new product development. Murdoch, what would you say is our biggest internal focus right now from a product kind of research perspective?
We're always constantly looking at, emerging narratives and trends in the market. Real world asset is one of particular interest. So there's actually a really great analytics website for those who like looking at that stuff, rwa.xyz, like Dune dashboards, or DeFi Llama, but for real world assets. It's also full of like really boring insto stuff. But one thing that's really interesting is that there's a growing class of tokenized treasury bills that are being brought on chain, and there's actually several different issuers of this. So why is this interesting? Well, I mean, treasury bills is like the most vanilla of financial instruments. I think this may be one trend that is going to be growing. I think if we ignore, like, I don't know, 300 million that's sitting on Stellar network by Franklin Templeton, there's about another 400 million of tokenized assets on various EVM compatible chains. And why is it interesting? Because treasury bills are probably the simplest token to asset to tokenize and bring on chain, and they have a very direct use case: stablecoins. Since the beginning of DeFi at all, there is always a new stablecoin. Like somebody's got it, whether it's liquid staking derivative or it was old school Luna Terra Ponzi or ohm backed or something. Like we've been through so many metas of stablecoins. We're due for a new one. Is it going to be based off of the treasury bill yields? I don't know, but I can just see that like there's a direct connection there. Someone's going to come up with some clever use case for one. So because we always have stable coins, treasury bills will definitely find some use, and that's a very scalable asset class. You can easily get billions, if not trillions, on chain if someone if there was demand for it, right? There's no end in supply. It's not like people trying to tokenize, like, I don't know, handbags and Ferraris, right? Like there's only so much you can do, but T-bills you can literally mint as many as you want. So I think that's an interesting asset class. It's more likely to increase in supply than decrease, so it's a good bet that it's a growing asset class. Now, what happens with that and whether anybody cares, we're not sure. One thing about DeFi is that I don't think anybody particularly cares for KYCing. I don't think people are opposed to KYCing. Like, if we remember all those, KYC permission launch pads, if people feel like they can make money, they will hand over their documentation, I feel. And so, like, are permissioned assets a new thing? It's going to be very challenging. We've been doing some exploration in RWA. I can only say that at this point, we feel confident that it's a growing asset class. We're not fully sure where our positioning or how we would get involved. But if there are assets and there are lots of issuers issuing different T-bill tokens, then someone's gonna need a T-bill token stable swap, right? It could be us. I don't know. The compliance and KYC aspects are horrifyingly disgusting, like, and a lot of work. So, is that something we want to get involved with? I don't know. Is there like a regulated KYC version of Liquidity Book that serves those asset class? Could be. Would it involve a lot of legal fees? Probably yes. But I think all of these things that we're keeping tabs on. We're thinking we do a lot of research before we commit into new features. But I think this is definitely something that we're keeping our eyes on, or at least I'm looking at.
Do you think now is like the right time for us to really kind of start digging into shaping or scoping out a V3 model?
Yes, I think so. Uniswap are working on V4, and there was a lot of discussion on that recently. A lot of people are now calling themselves hook developers and hook auditors, whatnot. And I think some of the other AMM providers or AMM tech providers, service providers, are also adding hooks and other such features to their stack. Um, for me, like, I take a step back and think about like DEXs and AMMs today. And what are the gaps to for profitable market makers, right? Like, why do I say profitable market makers? If we have to describe first, like, what is our ultimate goal with Liquidity Book, for me, it's to be able to have profitable liquidity providers. I think if like liquidity providers, that is the heart and soul of DeFi. If you can't provide liquidity, in DeFi profitably, sustainably, then what the heck are we all doing here, right? And so, I think early on, like Uniswap V2, people, started figuring out like some of the financial downside and risk aspects to becoming a liquidity provider. And with liquidity, when we designed Liquidity Book, we tried to add some features to counterbalance that, right? Like we hypothesized that by using liquidity bins, we could facilitate higher volumes between, within the bins or between ticks, as they call it on Uniswap. And more volume equals more fees. We also had dynamic fees, right? Because we had hypothesized that these kind of features will help market makers or liquidity providers be more profitable. Like that's our ultimate goal. So that being the goal, right? And where the state of DEXs and AMMs today, I think there are two gaps in the state of the art today versus where we need to be to continue to improve the profitability of liquidity providers. One is there's a concept called PTP, or price time priority. What the heck is that? So I think for folks that have provided liquidity in Liquidity Book today, might know what I mean by this. Suppose that the active bin is at, let's say, $10, 10 USDC to AVAX, right? That's the active bin. And you also add your USDC into that bin. Great. And then someone else also adds USDC, as well into that bin. All right. And then, a trade comes in and swaps AVAX into USDC. Okay, great. Now, who gets filled first? Let's say I provided first. Murloc adds 10 USDC and Davide adds 5 USDC. And then the trade comes in for 10 USDC. Now, if this was Binance, right, and you're putting limit orders, I would get filled first, and then Davide, right? But this is the liquidity providers. This is the bin. We all get a share of that $10 trade and the fees associated to it, right? Like even though I was first, I took on risk by being there first, and Davide came later. He had an equal share of that trade, like that volume as a market maker compared to me. And so that's the problem called price time priority, and I think that's something that does impact market maker profitability. The second is a more obvious one, which is order cancellation, right? Like today, if you put your liquidity on there, and then you see that some news dropped, and BTC just mooned or it just dumped. There's a big red candle, and you want to change your you want to rebalance your position quickly. You want to adjust your risk. So even with the brilliant past 1 second sub-second finality on Avalanche or whatever, right? You still have to pay gas, right? You can't cancel orders freely on the blockchain today. And I think that's also another aspect that impacts market makers and their profitability on AMMs and DEXs today. To me, those are two big user experience pain points that I think the state of the art of AMMs, not just Liquidity Book, right, or Uniswap or everybody, but like to the best of my knowledge, I think those are two big problems that are facing liquidity providers today. I don't know if those are the problems that we will focus on and solve. That's just my personal view on like AMMs today. We have a team of folks that are going to be working on this problem to work on the next generation of the Joe DEX. And the way that we always do things is by first principles, right? We will probably go back and revisit a lot of the assumptions and designs that we made for Liquidity Book in the first place. For example, like why are we still certain about constant sum between the bins, right? Like that was one selling feature, but are we actually sure that that's actually the best design choice? There are trade-offs. What about dynamic fees? We know for certain it improves the market maker profitability. How do we know that we are surging enough or quickly and fast enough? Should we be doing more in that aspect? Should we be optimizing that more? And I think those are just things that are off the top of my head. Like there are lots of different nuances within the design space of AMMs today. It might seem like everyone just has a Uniswap fork, but the truth could not be further than that. Like, it's not simple for regular folks to understand this, but I think for guys that have been working in this space for a long time, like, we appreciate like the different subtleties in design choices between different AMMs and the way that they're designed. One prediction I am pretty confident in is that I think everyone's going to adopt what is called the singleton. Rather than having different contracts for every pair, to be able to store, the entire AMM in one single contract. And there are some engineering advantages in doing so. Chief among them is gas saving. But I think it also allows us to do some interesting things, from a design choice. Like one thing I might want to explore is rather than setting the fees at a market level, could we set fees like at a token level, right? And maybe like there are some interesting changes to user experience there as well. So so that was a bit of a long intro, but from not just like Joe V3, like V3 of our decks, like we're not just looking at improving Liquidity Book. We would start from first principles, look at like where the design space of AMMs are today, and how do we continue to improve the profitability of market makers, liquidity providers.
Are you expecting Trader Joe to deploy onto more chains in the near future? What are your kind of general thoughts around how DeFi is changing in respect of lots of ecosystems are deploying?
Okay, so I think people just want to know whether we're going to specific chains and when, right? And I actually look at this slightly at a longer term view. I think that based on what we have heard and what we can observe, within like 6 to 12 months, there will be many L2s, and good chance is that most of them will be pretty crap, kind of like alt L1s. Most of them were there were a lot of them, and most of them turned out to be insignificant. Some of them even rugged themselves on the way, right? It's really unfortunate what's happening with Phantom and multi-chain and stuff like that. But that's crypto. Things will happen. So I don't think we're in the business of picking winners. I think that there are so many L2s. It's really hard. I don't, should you be on all of them, for example? Like, if you could be on all of them, why not, right? But I don't think that's necessarily something that is scalable or cost efficient. You have to be picking and choosing chains. So I think when we think about whether we want to go to new chains or not, there's a whole number of criteria. There's tech, there's business, there's competitiveness. But I think the one that Fish and I look at, I wouldn't say the most, but I think that's the one that's like, it's less, it's not least quantitative, is culture. Like, what we started on Avalanche, and Avalanche, for despite whatever people like either the maxis or people that hate or the haters say about it, like people have a very strong they have opinion on Avalanche. It's definitely not boring by any means, right? And there's a very strong sense of culture, and I don't think you can say that for every single chain. So Arbitrum, I think we had we were always very like attracted to Arbitrum, and when we dug in deeper, like we just loved the vibes of it. Like things might be looking a little bit quiet right now, but I think we've definitely enjoyed being a part of this ecosystem on Arbitrum. I think BNB was the one that we made purely on business decisions, and I think it took us a while to learn that like, hey, the culture wasn't really fitting what we're used to, that we allowed us to thrive on Avalanche and Arbitrum. So I think one thing that's harder to measure and important for us to do the kind of work and collaboration on that we've been successful on Arbitrum and Avalanche is culture. There has to be like-minded teams out there for us to work with. So coming back to like the main question, when new chains, I'm not going to be able to predict this. I can say that we're spending a lot of time looking at a number of new chains. I don't know when or why or how we would make those decisions, but I think there's two things, facts that I'm very confident about. Number one, there's a lot of chains in the future. Number two, it's a damn bear market right now. Volumes on all chains are kind of bad right now. Ace is the one that everyone on Twitter seems to be talking about, and we'll do our due diligence in. But we also know that with L2s, there's no sure thing that something that starts out hot is going to stay hot. Like this is a very long game, and I think one thing that is important for like over the long term is culture. So before we commit to any new chains, it's gonna be it has to be done with the right reasons, and chief among them is going to be culture. Mario has a question about culture on ETH. So I think ETH is the one that's a little bit different, right? Because
I've literally just been typing an answer. Yeah, it's a great question. Sorry, go on, Mullet.
Yeah, and no, I think your answer is great. As an AMM, you kind of a spot AMM, I might add. You have to be on ETH. Like ETH is where EVM, all the EVM dexes kind of measure themselves. I think it was a matter of sooner versus later. Maybe we should have launched later. I don't know. But Ethereum, I think it's not about culture. You just have to be there, and you have to be able to, if you believe in your product and your technology, it has to be on Ethereum. That's where the majority of liquidity and trading today happens. And right now it's a bear market, so things don't look so great. So we have longer. We're going to be more patient on our growth on Ethereum. It's going to take a little bit longer there. I wouldn't say that we're doing the similar approaches as we did on Arbitrum and Avalanche. About how new chain cultures impact the Trader Joe culture. That's a really good one. I do get the sense that today our community is much more diverse, right? There are some folks who come from Arbitrum. There are some folks that come from BNB. There's some folks that are OG from AVAX days, right? And I think having a really diverse mix, especially the market makers in our community, allow us to kind of have a strong community of liquidity providers and market makers and their strategies around a diverse set of assets. The strength of Trader Joe is only as strong as the market makers on it. I say that sincerely. And so, the more diverse we are, the more assets and more markets we're able to make. That simply. And the other part is memes, right? Like every chain, has its own memes. I hope, I fully expect us to develop new ones in the coming, months as new narratives and new memes come along. Being on different chains means that you are knowledgeable and stay aware of the new memes. That's and that's about community, right? Like making money, the market makers, the business side, and then the culture side, the memes.